Before we begin, it's my pleasure to introduce our speaker for today, David Ng. Now, David, he brings with him years of extensive experience in the derivatives industry and is widely regarded as an expert in this domain. Previously, he served as the head of marketing at Philip Futures, where he successfully led initiatives to drive growth and development in the derivatives market. Currently, David is a full-time proprietary trader with ExpertX, which is a local proprietary trading firm. His deep expertise and practical insights, which makes him an invaluable resource for today's session. And we are truly delighted to have him here with us sharing this topic. So, without further ado, please join me in welcoming David Nguyen. David, the floor is yours.
Yeah, thank you, CY. So just before I start, just like to do a sound check. Are you able to hear me?
Yes, I can hear your voice clearly.
Okay. Are you able to see my slides?
Yep, your slides is up also. Good to go.
Okay, yeah, thank you very much, CY, for the confirmation. Yeah, just before I start, just like to thank the audience for joining in tonight. Hopefully you had a wonderful dinner just before the session. And obviously just like to thank Excellent as well as Bursa Malaysia for inviting me to speak on today's topic entitled, Mastering Heiken Ashi and also DMI. Now, if you are new to Heiken Ashi and DMI, basically these two are technical indicators that's widely available, and nowadays I think it's getting more popular and widely used. Especially when it comes to looking at trends in the market, using tools that enable you to identify opportunities using trend indicators. So these two are mainly trend tools that you can utilize, especially when to look at trends in the market. So hopefully, in reference to the Malaysia futures market, the CPO and FKI market, recently you notice that both these markets have actually experienced in terms of what we call short-term bullish trends in the market. So I think there is opportunity that's present. Then hopefully, in those opportunities, you can find ways and tools to navigate those opportunities. So let's just begin. I'm just going to start off also with just putting out a disclaimer. So I think any materials presented here today is purely for educational purpose. And content here is purely, if you hear any opinions, it's purely reflecting my own personal opinion, doesn't reflect opinions, whether it's from the exchange or whether it's from the organizers, Excellent in this case. And if you are new to futures market, futures is a derivative instruments. We are dealing with something that is highly leveraged. So therefore, it requires a lot of effort of understanding it. Make sure you are well equipped, get the right resources, from the reliable, organization or even reliable website. So make sure you are well equipped before you actually begin your journey in trading futures market. Now, in the next hour or so, I think what I'm going to cover is just looking at some of the key tools that we can use in this regards, Heiken Ashi and DMI as part of your technical arsenal, as part of your toolbox, for you to actually construct a trading procedures or trading plan for you to navigate, especially the Malaysia futures market. Now, why Heiken Ashi is so popular is because I think there's a lot of reasons why it's simple. It's easier to identify in terms of trends, and the patterns are easily recognizable. Unlike, if you look at many other types of, the most commonly used is Japanese candlesticks, and I think the nature of Japanese candlesticks being, you have so many numerous patterns to master and to really distinguish. It's not easy. It takes years. It takes multiple charts to go through to really understand and then really master Japanese candles. So in a sense, Heiken actually comes in handy if you want to look at trends in a shorter period or in a particular period. It does helps you to indicate trend in a better manner. I think DMI is a great tool, not only for the crossover strategy, which we're going to discuss later, but really I think, as if you look at DMI as an indicator itself, that's what we call one line called ADX, Average Directional Index, and that is very important. So once we identify trends, that is always crucial to understand whether the particular trend is it still strong. There's no point entering to a particular trend when the trend of the market is already exhausted. So especially if you're trying to enter a bullish trend when the market is already quite peak. So ADX is a very good indication to tell you whether is the market still trending, is there strength to the particular trend. So I think in that sense, ADX comes in very handy to help you to determine whether the trend can still persist or is it going to face exhaustion in time to come. Last but not least, I think in every trading plan that you intend to embark, you must have a way to always manage your risk. Now, this year is definitely going to be it's going to be very volatile, and it's already in a very volatile period. Reason being is because of Trump. If you whether you're doing equities, you're doing commodities, whatever Trump says or tweets, he does move the market. So when volatile markets like this or condition like this, is always very vital or imperative that we must have a way to manage your risk. I always share this with audience, especially for those who are new to trading, is that you must have a way to manage your risk. If you don't do that well, technically is you're going to ruin your account. So always make sure you must have a way to manage your risk. So in this regard, today I'm just going to share with you how to use value of ATR, stands for average true range. Use the multiple of ATR to manage your profit target, and importantly is actually your risk. So in every trading setups that you have, you must have a way to manage your risk accordingly. So just to give you a technical overview, so this is where we are in palm oil market. So over the last couple of days, we have seen prices actually did rally quite strongly on the back of very strong fundamentals, and there's a lot of positive narrative that's coming from the market. So we have seen prices move from 4,001 to 4,200 ringgit. Right until today, I think we've seen almost as high as almost 4,600 ringgit per ton. So in fact, indeed, short-term wise, the CPO market does shows to you that clearly the short-term trend in the market is still an uptrend market. Now, if you look at it, this is where we are, the highlighted circle. The candles are both the 50 period and the 200 period exponential moving average. So it does indicate to you, as long as candles are above the long-term moving averages and the medium-term moving averages, technically it's telling you short-term wise we are entering into a bullish phase in the market. One key thing to take note is that when it comes to trend trading, it's important that if the trend is on an uptrend, it's very vital for you to find position too long. It's very difficult if the trend is bullish, but if because the hesitation of a human nature to see that, hey, I don't want to look foolish by taking a long position at the peak. Market can always, if market is on a bullish phase, market can go even higher. Despite we take a long position at almost at the top. Market can always go higher because when market trends, it does have the momentum. So I think that's one thing to take note of. If you are doing trend trading, it is very vital. If the trend is bullish, it is important for you to always find position to long rather than short. Now, on vice versa, if the market is on a downtrend, always find position to short rather than long. Because I think it's human nature to always try to pinpoint, especially when markets are trading, to pinpoint reversal in the market. It's never easy to do that. So I think if you just look at this, these two lines here, this is basically the 50 period and the 200 period EMA, and these are on daily candles. So you can see currently, I think FCPO market is clearly on a bullish phase, given that the candles are way above the 50 period and the 200 period EMA respectively. Okay. Now, looking at FKLI also is encountered a very similar sentiment as well. Market, I think, in fact, is actually very bullish once it crossed the 50 period and 200 period EMAs. Now, the reason why I use these EMA lines, moving averages, for those who are new, it gives sort of like, EMAs or moving averages in short, gives you an indication as to where the market is heading. As long as the line is heading to a certain direction, it's telling where the market is going. Now, not only that, I think if the candles are trading above both the candles or both the moving averages, it also does shows you that generally the market is on a bullish phase. So we have FCPO and FKLI. Both markets are definitely on experiencing a short-term bullish trend in the market. So when it's short-term bullish trend in the market, it's always good to find opportunity to long rather than short. So I just want to introduce to you Heiken Ashi. So for those who are not familiar with Heiken Ashi, now it's nothing new. It's basically just a derivatives of I wouldn't say derivatives, it's just basically an extension of Japanese candlesticks. Now, if you compare these two charts I have here, now this is looking at CPO. It's the same product, both are CPO market. same time frame, same time period. The only difference is the type of candles. Now, if you ask me, if you just look at the observation of a chart itself, if you really want to do trend, now there's chart A and chart B. Now, if you are doing trend trading, which particular chart will you be trading? Now, maybe you can just type some answers in your chat box, and maybe just want to get the audience, which chart would you prefer if you are doing trends in the market. So I just want to pause for 10 seconds just to see your just to see the responses. Yeah, so most of the response are pointing to chart B. Why? Now, if you look at it, is if you are doing trends, if you want to look at trends in the market, you can clearly see that, if you look at chart A, this is clearly a downtrend, then suddenly you start to see appearance of a green candle. This is where, if you're holding to a short position, you'll be wondering, oh, potentially this could be a reversal in the market. I should be exiting. Now, if you look at Heiken Ashi, on the other hand, it still points to you a downtrend market. Despite these two candles are showing you probably the market is ranging, but generally the body candle of the red bar is getting very wide. So it's just telling you the downward strength is still very strong, despite there's a bit of short-term retracement in the market. So to look at trends, I think Heiken Ashi is very beneficial. Now, the only downside, or I would say the only difference, not a downside, the difference is if you compare chart A and chart B, you notice that chart A you can see price gaps. Here you can see gaps, but in chart B, when you use Heiken Ashi, you can't see the gaps. It's represented by the candle bar. So if you are looking at gap analysis or gap trading strategy, you can't use Heiken Ashi at all, because then you have to convert back your candlesticks, your Heiken Ashi candles back to Japanese candlesticks, where you can start to see gaps in the market. Now, other than that, I think if you want to understand the short-term trend behavior of the market, Heiken Ashi is actually quite useful. So this is where I meant. So example here, this area which I'm pointing to you right now, you can see there's series of green, then suddenly there's a red candle. So you'll be wondering, is this an uptrend or is this going to be a sideways? Now, if you look at Heiken Ashi, it's still showing you green candles, despite there's a cross. Normally you should be careful and wary, but the next candle is still a green, is telling you this upward momentum is still pretty there. Now, obviously, if you use Heiken Ashi alone to look at trends, it's not observable. You need other things like moving averages to pair that, or even like DMI, which we're going to share in the later part of the slides. So really, I think Heiken Ashi candle is very useful to look at trends, especially short-term trends in the market. Now, so this is basically the distinction of Heiken Ashi. You can see that, in Japanese candlesticks, I highlighted earlier, if you want to master Japanese candlesticks, it takes a lot of time, because if you read Steve Nielsen's books on candlesticks, Japanese candlesticks in particular, he talks about 100 different patterns. Now, to really master 100 patterns is never easy. It takes years. It takes a long time, and it requires you to look at so many charts on a daily basis to really recognize a particular configuration of pattern that is very distinguishable. That's Japanese candlesticks. Now, in Heiken Ashi, you don't have to do that. There's only 3 distinct patterns that you really need to know. So what are the 3 distinct patterns now? As long as you see red candle bar with upward and lower wick, it's usually a sign of concern. So if it's a downtrend, you start to see red candle bars with upper and lower wick, is just telling you that this particular downtrend is almost exhausted. So technically, the momentum is going to be weak. Vice versa, if you suddenly you see green, you see white green body bars, and suddenly you start to see appear a green body bar with upper and lower wick, then you should be very wary, because that is also time or condition that the market, the upward trend in the market is facing exhaustion as well. Now, the second pattern is this. If especially in a green candle, you start to see upper wick, this is a good candle to look at, because generally that means that the market bullish phase is just started or in the process. Vice versa, red candle should only have a lower wick. Now, the moment you have upper and lower wick, that tells you that the momentum is getting weaker. So now the best is if you start to see candles with no upper wick for green body candles, and it's a very white body, that generally tells you the market is very strong. So that could be it could be a price gap up, and it continue to go higher. That's why the body of the candle is green. There's no upper wick. In those candles, those are very strong candles, and normally that usually be something that you should really look out for. Is it a sign that the market is turning very bullish? Same goes, if you start to see a very white red candle with no lower wick, it's just telling you there's a very strong downtrend in play. So it's going to be, those are the candles that you have to pay a bit more attention to as well. Now, the third pattern is what we call almost like a dodgy style or like a cross style, where the bodies are very small but the wicks are very long. So in these instances, normally it just tell you, normally this usually occur when markets are moving sideways. So after a trend phase has done or evaluated or finished, normally the market will go sideways to consolidate. And that's where it appears those dodgy type of candles like this. So in these instances, normally if you try to look at trends, it's very difficult. Market is heading nowhere. It's in a tight range. So we've seen that, in KLCI for actually quite a few months. Only reason I think this month onwards we start to see the bullishness in FLY coming back again. So really, when you start to see this type of appearance of candle where the candles are, the body of the candles are very small, almost like a dodgy style, that usually tells you or signifies to you that the market is going to go sideways. So this is how you apply. So you start to see a series of white green body bars. It's just telling you the market is heading higher. It's a bullish, short-term bullish trend. Vice versa, long red body bars is just telling you the market is on a short-term downtrend. This is where it gets interesting. You start to see, long wicks but small body. And when green candles and red candles appear side by side, that usually tells you, if you're holding to a position, you better be careful, because that generally tells you the market is going to go into a range, or it's going to be a tight range before it trends to the next direction. So it's important, once you start to see this type of appearance of candle coming into play, it's just telling you, be prepared, market is moving sideways. Now, so basically these are the difference between Heiken Ashi and Japanese candlesticks. So Heiken Ashi, 3 major forms, Japanese candlesticks, 100-hour combination. So I just mentioned that earlier. So Heiken Ashi is more to trends. It follows the trends accordingly. Japanese candlesticks, you look at patterns that you observe. At most of the time, the pattern always tells you when the market will likely reverse. So it's very trend reversal in nature, or reversal pattern in nature. So I would say if you're looking at gaps or price gaps in the market, you just can't use Heiken Ashi. You just have to use Japanese candlesticks, as a way to look at gaps. Now, basically, this is how it's calculated. So a lot of people also like Heiken Ashi is because if you're doing automation or you're doing, automated trading, you can actually quote the formulas of Heiken Ashi. You can quote the candles calculation itself, because it's based on a fixed calculation. So if you look at it, the calculation per se is really looking at the average bar of a Japanese candle. So technically, you are looking at the average of the average of the price movement. That's why you can see trends easier. So therefore, if you want to quote a particular candles using Heiken Ashi formula, you can do that. Japanese candlesticks is very difficult for you to quote. It's based on patterns. So that's why it becomes becomes in a way more popular, because you can actually quote it, and in a sense that you can actually input it into into your automation or trading automation. So I'm not going to go too detailed on the calculation. Nowadays, with advanced technology, with so many charting platforms that's out there, it's just a simple click of a button, you can straight away see a Heiken Ashi type of candles. You don't have to, those days you just have to calculate. You don't have to do that anymore. The charting platform nowadays, or even the brokers, will provide you that necessary candles just with a click of a button. Okay. So I think mainly just be aware the difference between Heiken Ashi and candlestick is really down to the way they identify the direction of the candle. So candlesticks are very pure in nature. You look at open, high, low, and close, while Heiken Ashi is taking the averages of those open, high, low, and close data. Now, just put into dynamics, this is how it works. So you start to see a series of green, red, and very small body candles. This is just telling you market is actually side range. Now, the moment when you start to see white, green body bars, this is where it gets more interesting. So it's just telling you that potentially this could be this area here is potentially could be a short-term uptrend in play. Now, vice versa, if you start to see, notice this, when the body of the candle starts to get smaller and the wick starts to get longer, that generally tells you this uptrend is going to be exhausted or pretty much at a peak. Now, when the moment you start to see red candles appearing and the bodies are also quite white, that you should be careful. It also could be a sign that is telling you the market is poised to go lower. There's a change in trend happening. So that's the dynamics of it. Always remember, you always prefer trend usually be identified through the body of the candle. You should have a white body candle to indicate to you where the market is probably heading. So once you have to see a smaller body candles, like the rectangle areas here, which I highlighted, is just telling you, and a series of red and green together, is just telling you the market is range. So when the market is range, if you try to do trends, strategy is not that effective. That you have to revert into range trading strategy or mean reversion, we call it. Now, you can apply the same dynamics on FKLI. It works the same. In fact, I think in certain instances, a certain time frame, FKLI does display there's a higher tendency to display trend formation using the Heiken Ashi. So again, the same principle. When you start to see white body candles, that's where you pay a bit more attention, because that generally tells you, that potentially there's a trend in place, and the strength of the trend could be quite strong at that point in time. Now, this is what I meant, the difference between Heiken Ashi and Japanese candlestick. So you can see very clearly, first thing, always the biggest difference is the price gaps. You don't see that, in Heiken Ashi is represented by the body of the candle. And another thing is that you always look at it, when you start to see Japanese candlestick, if you use Japanese candlesticks, when you start to see series of red and green, you're not sure whether is it trending the market or is it a range market. If you turn it into Heiken Ashi, you can see clearer. Actually, the market is trying to do a downtrend phase at that particular point in time. So you can see quite clearly when the market tried to recover, people thought this could be a short-term retracement or potentially to be a change in trend. If you look at the candles in Heiken Ashi, the body of the candles are still small. It's not wide enough to warrant there's a change in trend. Unlike here, when you start to see the green candle starts to get very wide in terms of body, then this warrants a change in trend. So that's where Heiken Ashi comes in handy to roughly tell you, to indicate to you when a trend is forming and when a trend is strong. So it's always represented by the body of the candle. Now, so this is also just to give you indication. This is using FKLI as an example. So this circle area is very unique. So this daily candle. So you can see that one day the market can close high, the other day can close low. So in this example here, if you are taking position based on Japanese candlesticks, you can't really see a clear trend. But if you look at Heiken Ashi, you can see that the market generally is still heading higher. As long as the daily candles are making higher highs and the lows are also getting higher, generally this is a short-term uptrend in phase. So here again, it's also the same principle. Generally, this part here is telling you this downtrend on Heiken Ashi candles is just telling you when you start to see body candles very small, this downtrend is almost exhausted. So you should be careful. You're holding short position, you should be getting out when the body of candles are getting very small. And when you start to see appearance of green candles, it's just telling you the market is poised on a reversal to the uptrend phase. So all in short, you can really clearly see, even look at trends in the market, Heiken Ashi is a much better candle to utilize as compared to just looking at Japanese candlesticks. So now, Heiken Ashi alone is not suffice. You need definitely you need to pair with certain other indicators. Now, moving averages is one commonly used indicator or trend indicator as well. There's many types of moving averages. Some may use simple moving average, some may use exponential moving average, some may even use weighted. There's so many, but I think commonly people always use exponential. Reason being is because exponential will put more weight on the latest data. So if you look at moving averages in terms of lines, you notice that you use EMA, it tends to hug the price quite closely. If you use SMAs, it may not be that clear. So in a way, sometimes you may thought that, oh look, is this a signal to gather or not? So there's a bit of confusion over there. So it's always good, if you use because keep in mind, moving average is still a lagging indicator. So when it's lagging indicator, obviously you need something that is quite responsive. So EMA is one good type of moving averages to be used along with Heiken Ashi to give you a better signals as to when to navigate opportunities in the market. So just to show you the difference, this is basically EMA and SMA. So one is exponential and the other one is simple moving average. So you can clearly see the black one is EMA. When prices starts to move lower, the EMA already curve downwards much faster as compared to simple moving average. Now keep in mind, moving average in general is still a lagging indicator. So my EMA tends to envelop the price movement quite closely, or in a way much faster compared to simple moving average. So therefore, EMA is widely used. So having said that, so how do we use a moving average? Generally, we always pair a shorter time period moving average with a longer time period moving average. So in this sense, in this example, we are using a 9 period and a 20 period EMA. So from there, what we do is always we look at crossover strategies on your moving average. So as long as the shorter term crosses below, generally that tells you, and the candles are moving below both the moving averages, generally that tells you the market is on the downtrend. Now, if the shorter term crosses above and the candles are moving above both the moving average, generally that market is telling you is a short-term uptrend in place. So that's how we pair Heiken Ashi and moving averages together to tell you where the trend on the market is in relative position. So as long as the candles are above the moving averages, generally that tells you the market is on an uptrend. If it's below, generally it's a downtrend market. And crossovers also give you just a signal as to where where the likely shorter moving averages is crossing with the longer term moving averages. Now, so just to give you an illustrative example here, we have on FCPO market. This is what we call a bearish crossover because you look at it, the shorter term crosses below the longer term, and notice that the candles formation, the red candles are forming below both the shorter and the longer term moving averages. So, and the Heiken Ashi bars are very red. So the body of the red Heiken Ashi bar is white. It's just telling you that this downtrend is actually very strong. So right until when it comes to you start to see series of green candles and the bodies of candles are very small. Generally, this market is moving to sideways range. Now, not only moving averages helps you in terms of crossover, it's also acting as a support and resistance, dynamic support and resistance to your candles as well. So if you notice this part here, the red candles are most of the time trading below the shorter moving averages, the 9 period EMA. It doesn't penetrate. Only at these instances it penetrates once, but it failed. So generally, it's still a downtrend marker. Right until when you start to see this circle here, the appearance of green Heiken Ashi candle starts to go above, but again, it failed to hold above both the moving averages. So in a sense, the moving averages is not only giving you direction of where the trend is, it's also helping you in a sense that giving the dynamic support and resistance level to the candles. So as long as the candles doesn't break, so during a downtrend market, if the candles doesn't break both the moving averages and is holding well below the shorter term moving average, it's just telling you this downtrend is still quite intact. The moment when the candle starts to break above both the moving average, that's where you need to be careful. That could be a sign that this downtrend is probably going to turn into a reversal market, into an uptrend market. So that's where it comes in handy to use moving averages, not only for the crossover, but it's also to indicate to you where is the likely support and resistance level are based on where the position of candles in relative to the moving averages. So here, another classic example, you can see, this green Heiken Ashi candles forming, but it's well supported, with the 20 period, which is the longer term EMA, the black line here. It doesn't fail to penetrate below. So as long as it doesn't break below the 20 period EMA, it's just telling you that this uptrend is still quite intact. Now, of course, with Heiken Ashi recognition, with green Heiken Ashi bars, it's well comfortable that this uptrend is still quite intact. So don't keep in mind, moving averages is not only telling you crossovers, but it's also giving you the dynamic resistance and support level accordingly for the candles as well. Now, so this is on FKLI. You can also see very similar setup. Again, here you can see there's a strong bullish crossover. Green Heiken Ashi bars, normally this is just telling you this uptrend market is actually quite strong. Now, the moment when it breaks below the moving averages, that generally tells you the market is heading on downtrend basis. So this is a very good indication. The one I highlighted here. There's a couple of instances where the candles are well supported, especially above the 20 period EMA. So as long as you want to know whether this uptrend is still intact, as long as the candles are above the 20 period EMA, which is the longer term moving averages, generally the uptrend is still quite intact. The moment it breaks, that is where it usually signals to you trend is changing. So as this instance here, it's been a strong uptrend. It's tested, but it never breaks successfully. Only in the next couple of candles it breaks successfully. That generally tells you this market is heading downward. So, it's a good indication. The moving averages helps you to also gives you where to identify the dynamic resistance and support levels are for the particular candles. Okay. Now, so that's on moving averages, and to use that in accordance with Heiken Ashi, the second indicator to look at is what we call DMI. It stands for Directional Movement Index or Indicator. Now, in DMI, I don't go too complex to explain it, but basically there's three lines you need to observe. One we call it positive DI, or we call it plus DI. The other one's negative DI or minus DI, and the third one, which is the most important, as part of DMI indicator, is what we call the Average Directional Index, which is ADX for short. Now there's certain other indicators that comes to the fourth line, which is just another average of the ADX. Sometimes you don't need to do that. You can just use ADX. It's just sufficient to indicate to you the strength of the market. But if you just want to get the average, another second derivation of the ADX, you can do that. But sometimes it defeats the purpose. So very important, I think just these three lines are sufficient to give you an indication whether the market is trending and whether the trend is still strong or still persisting. So DMI, it works very similar in terms of moving average as in the crossovers, which we're going to share with you in the next couple of slides. So if you recall back, moving average crossovers, when your shorter term crosses below the longer term, generally the market is on the downtrend, and if the shorter term crosses above, generally the market is on the uptrend. So very similar concept on the DMI as well in terms of crossover strategy. The only thing is that what we should be paying more attention to is the ADX. Now, ADX runs on a value from 0 to 100. So as a general rule of thumb, if ADX value between 0 to 20, that tells you market there's no trend, it's range market. Now, the moment when ADX goes above 20, let's say 25 and above, that's where you have to pay a bit more attention and focus. That generally usually happens when trends are forming. So, if an uptrend starts on a very beginning phase, you can see ADX start rising above 25, and you must have green Heiken Ashi bars to accompany that, or at least a bullish crossover on your moving average. Once you see that generally tells you, or quite comfortably, the probability of the market continue its uptrend is quite likely. Now, if ADX is not above 25 and the green Heiken Ashi bars is just showing you the market is poised on uptrend, it's still not determined whether this uptrend can sustain, because the ADX is just not rising. So ADX is very crucial to help you to identify whether the strength of the trend is it still persisting. If it's not persisting, then we really have to be careful. So this is what I meant. So just to look at DMI crossover, so we have two lines here, the green and the red. So the green is positive DI, the red is minus DI. So the moment when it's crossover is usually we call it positive crossover is when a positive DI crosses above the minus DI. So when this happens, there's a tendency that the market will trade on a higher level or pretty much on the uptrend phase on the short term wise. So you can see that if you look at crossover strategy on moving average, it's actually quite similar. So in the sense that the DMI crossover strategy and the moving average crossover strategies are actually very similar, in fact. So in a sense, both these indicators are giving very similar signals. In a way, it's overlapping each other. So it can be redundant. So in other words, you can either choose a moving average crossover as a way for you to navigate the market to determine whether the market is poised to go on an uptrend or downtrend, or you can just use DMI crossover strategy as a way to compensate if you don't want to use the moving average crossover. So because both these indicators are very similar in terms of their signals. So then what is the reason of using DMI? Now, the reason of using DMI, so this is just to show you the DMI crossover strategy for the FKY market. Again, it's very similar. Anytime when DMI crosses, there's a crossover happens, normally the moving average also giving you a very similar signal. So in a sense, both of these indicators are overlapping in terms of their signals. But DMI is mainly used for ADX, which is this black line here. Now I've removed the positive DI and minus DI just to give you a clear indication on how the ADX line works. So I mentioned earlier, ADX runs on a value of 0 to 100, something like your RSI and your MACD indicators 0 to 100. So the general rule of thumb is that 0 to 20 normally is just telling you the market is range. There's no point for you to look at trends. So just to take instances here. So here we have the market doing ADX doing below 25. The red line here is actually 25 points level. So right around this time, the market is actually in a range. Now, This is interesting. When the ADX starts to rise, you can start to see this downtrend starts to gain momentum. So, ADX tends to rise when market trends start to gain strength. So it's a good way to gauge whether the trend is very strong or the particular trend is facing exhaustion. So when ADX starts to peak, you can see that this downtrend looks like it's going to be exhausted. So always watch out. You want to see a trend is strong, you must see ADX rising. So this couple here, you can see that the market is range because ADX is below 25. But when ADX starts to go above 25, you can see that this uptrend that's in place is actually gaining strength. Right until the peak here, you can see when ADX starts to decline, you have to be watching very closely, because that usually tells you that generally the market is facing exhaustion. So during this peak here, this uptrend peak here, you can see that the market is in a way facing a bit of lacking of strength to continue its uptrend momentum. So ADX is a very good barometer for you to gauge how strong in the trend of a particular trend is. So there's no point for you to enter a trend when the ADX is not rising. That generally tells you that there's not much of momentum left in a particular trend. So if you're holding to a position, you can watch ADX as a way to make sure that if you're holding to a long position, the moment you start to see ADX starts to fall, especially after it's risen quite substantially, those are the first few signs that you have to be careful. That generally tells you that this upward momentum that's in the market is slowly losing strength. So that's one way to gauge, especially when it comes to looking at strength of the market. Okay, now this is basically an FKLI example as well. So you can see generally FKLI has actually been quite a range market for quite some time. Only in recent weeks we have seen that actually, in fact, the market has actually broken its key resistance levels and slowly heading into a trend market. So what we have here is that when ADX starts to break above 25, you can see this big upswing or price rally that we're seeing is actually quite substantial. So in a way, ADX gives you a good indication as to whether the potential change in trend is it going to be strong or it's likely going to face exhaustion. So classic example here as well, you can see there's a strong white body, green body Heiken Ashi bars, and the ADX is rising above 25. Just telling you this uptrend is actually quite strong at this particular point in time. Now, so if you look at it, if you put it all together as a basis, you look at DMI and you look at EMA as a strategy. Both of them in terms of crossovers are very similar, but DMI is mainly used to look at how strong a particular trend is. So this example here, we have appearance of red Heiken Ashi bars. Both the candles are below both the moving averages, and you have negative crossover because the minus DI crosses both the positive DI. One thing to take note is that this black line, the ADX is rising. So when ADX is rising, is this telling that this downward momentum is gaining strength? And when that happens, that usually is a good sign that if you're holding short position, you should be holding on to your position right until when ADX starts to peak. When ADX starts to peak, normally that's a time where if you're holding to your short position, you should be careful, you should be wary, and it's time for you to get out of the market. Okay, now. If the market is sideways like this is basically ADX falling below 20. There's generally not much of a trend that you can see, because when ADX falls below 20, it's just telling you that the market is ranging. When market ranging, you try to look at trends, it's very difficult. Only when ADX starts to go above 25, like this area here, it's just telling you this bullish phase that we're looking at in the particular candles is probably going to gain some strength. So that's where it'll be a good setup for you to look at, or for you to take a long position at this point in time. Okay, so what we have covered is looking at candles, type of Heiken Ashi candles as a way to look at short-term trends. You pair that with moving average crossover, you probably can get pretty much a gauge to where a particular market changes in terms of trend. And to pair that with DMI to look at strength, with using the ADX value is a good way to gauge whether if you're holding on to a position, especially in a trendy market, is there still strength left, and that's usually indicated by ADX. Now you want to hold to a position where ADX starts to rise. You don't want to be holding on to a position where ADX is at a peak and starts to fall. So when that happens, normally it's just telling you that particular trend is exhausted, or rather you're entering almost at the tail end of a particular trend. So important to watch out. I think ADX is very useful in terms of looking at or gauging the market strength in terms of trend formation. So the last bit I think I just want to share is to always manage your risk. Now, I think if you have been doing trading for quite a while, there is always many ways and methodology that you can employ, especially when it comes to managing your risk. There's could be, you can use a numerical value, you can use a fixed percentage of a loss per trade. There's many ways. Now the key thing is that you must have a way to manage your risk. Now I think one of the ways you can do it is to look at the range of the market. In this sense, looking at ATR, stands for average true range, the true range of the market, and from there establish your risk parameter. So like I said, there's many ways. If you're comfortable with your own strategy, existingly, if you really have your own strategy to manage your risk, so be it, stick to it. Now, as long as you must have a way to manage your risk, because trading takes a lot of discipline. If you don't manage your risk well, eventually your risk of win is going to be there. So as long as you manage your risk well, eventually I think once you have the trade is in your favor, the market will be very rewarding. As long as you manage your risk well. So the last bit I'm just going to cover is looking at how to manage your trade risk using the ATR value. So I'm not going to go too detailed on ATR, what's ATR and whatnot. Nowadays, I think you can obviously use ChatGPT and we can explain to you quite elaborative on what this indicator is all about. But I think in short and essentially what this indicator tells you is basically the true range of the market, the highs and the lows. So, if the true range of the particular period that you are trading is, let's say, 10 points, then the ATR is value of that particular period is 10 points. If it's 15 points, it's 15 points. So keep in mind, I think when markets are very volatile, generally you expect ATR value to be huge. So in a sense, if you are using ATR as a way to manage your risk, then technically you have to prepare, or rather you have to buffer a substantial risk because the market volatility has actually risen. Now, why ATR? Because I think if you set too tight of a stop loss for as part of your trading risk management, if the market is not, especially when the markets are ranging, it's very tough. Most of the time, you set too tight of a stop loss, you get stopped out quite easily. So if you're having an ATR, you are using the range of the market as a basis of you to manage your risk. So in that sense, you don't get stopped out that easily. Now, I will say one particular downside is that when markets are very volatile, when you talk about 100 or 200 points movement per day, that's where you really have to make a decision. If it's too huge of a risk for you to take using ATR value, then you have to go back to other types of ways to manage your risk, whether it's using a percentage, a fixed percentage, or a fixed value, so be it. But as long as you have a way to manage your risk at the end of the day, so ATR is a good way to start off with, as a way to really measure your risk and reward accordingly. Now, so basically, just look at this. This is daily ATR value, the bottom panel, for FCPO market. So if you recall back in 2022, during the peak of CPO prices, when it reached as high as almost 8,000 ringgit per ton, the daily range in CPO market at those days is about 400 to 500 ringgit per day. Those are quite crazy volatility. So if you're using ATR at that point in time, then you are buffering quite a big substantial risk as according to the market, because the volatility has actually risen. Now, over the years since then, I think market volatility has actually started to decrease. I think right now per day range you're looking about easily 100 to 120 points on the daily period. So that's usually the ATR movement. Now, if you compare back in 2022, obviously we came down quite substantially in terms of volatility. But then again, 100 to 120 is still quite substantial. As compared, if you look at FKLI, generally the movement is much lesser. So that's using an ATR as a way to manage the risk. Now, ATR is not only in terms of telling you the true range. Now, ATR usually rises also when markets are trending. If you notice, when ATR starts to rise back in the early part of 2022, you notice that the market is actually trending upwards. So generally, when market tends to trend, you can start to see ATR actually does increase, because it's telling you the range of the market is extended. So that's one good observation, or one good tool that you can observe, is that if you want to notice if there's trend in the market or is the trend forming, one good indication also just look at the ATR value. If the ATR value starts to increase, basically it's telling you the expansion in the market is starting to increase, and that usually happens when market is trending. Now, if you just look at recent ATR values, despite I'm saying, for the past couple of months, the ATR for CPU has actually been quite minimal in range, but only in recent weeks we have seen that ATR actually rises above 100. So per day range, you look at ATR value is easily between 100 to 120 points. So again, it's just telling you when ATR rises, generally it tells you trend is actually forming in the market, because when trend happens, it actually expanded the range, the movement of the market in general. That's why ATR value rises. So FQI is also very similar. Keep in mind, since June, between June and July, the daily range is actually very flat. So in a sense that you're looking at about 15 to 20 points, or even less than that. Right now, you can start to see that ATR is actually creeping higher. So again, when ATR starts to creep higher, that generally tells you, usually happens on the onset of a particular trend. Now, if you bearing the unforeseen risk, if you recall back in 1st April, where when Trump started the tariff war or tariff implementation across the world, you can see there's a knee-jerk reaction in the market. But I want to highlight is this: every time there's a sharp retracement or a sharp downside in the market quickly retraces itself as well. So really, we are talking about as when there's a retracement opportunity in the market, that generally tells you usually there's an opportunity for you to look at in the market. Now, FQI, you can see that the candles are very well supported on this is basically looking at 50 period and the 200 period EMA. So the 50 period EMA is actually providing a very strong support in a sense for the FQI market. And right now, the candles are trading both above both the moving averages. So it does tell you short-term wise, it's still quite a bullish market for the FQI for now. But if you just look at ADX on the latest print, you can see that pretty much FQI is actually moving sideways, given that ADX is slowly coming down. So it does indicate to you whether this bullish phase might find it hard to really extend further. It really needs to have a bit more momentum to really break up for the next leg in terms of the bullish phase that's looking at. Okay. Now, I don't go too detail on how to calculate ATR. Right now, it's so simple. You just click a mouse, you can probably get a value in an instant. So really, I think ATR is just looking at the true range of the particular period. Now, how do we use ATR as a stop loss management? So now, if you just look at this print here, now when you start to see candles appear, Heiken Ashi candles appearing, and the candles are trading below both the moving averages, and when you have negative DI, the key thing is that ADX is rising. So when you start to see ADX rising above 25, that usually tells you that this downtrend could have a bit more strength. And at that time, ATR is at 22 points. So generally what you do is that you get using the ATR of 22 points, you calculate your measurement of risk and measurement of reward. Now, if you work on a risk to reward ratio of 1 to 2, that means you're willing to risk 1 ATR for 2 ATR as a reward. Generally, you are looking at if ATR value is 22 points, generally you are risking 22 points for a reward of 44 points. So that's how you place your profit target and also your stop loss accordingly. Now, importantly, 1 to 2 is very ideal. In general reality, sometimes you may not even hit 1 to 2. In fact, you may hit maybe 1 to 1.5 or 1.6 as long as your profit ratio is higher than what you're willing to risk, and it's a positive expectation, that usually be profitable. There's no point to do a 1-to-1 trade. If 1-to-1 trade, generally you're always on the losing end. So keep in mind, you should have the reward. You should expect higher reward as per the risk that you're taking. Okay. So I think this is what happened next, your entry, and this is your pretty much your exit signal. Now, there's a lot of argument. If you look at this, at this point, the ADX is still rising. It does indicate to you that, your exit points, the market, after it exited the market still on the downtrend phase, because the ADX is still rising, because the ADX only peaks right until, when you start to see there's an appearance of green or dodgy type of candles appearing. So there's a lot of argument to it. Now, for me, it's simple. If it's a plan that you have already enforced by having a preset determined target for profit and a preset determined target for risk, just stick to the plan. Just keep in mind, eventually the market can always present other opportunities as well. You can't always ride the whole cycle, but I think it's as good as, if you follow your plan accordingly, that is what you have set out to do. that is, I think, is good enough to begin with. Okay, now another example here. So we have, this is very strong red Heiken Ashi bars telling you that this downtrend is actually probably getting strength and getting momentum and strength. So ADX just crosses above 25. So this populated candle here that's appearing, it could be a good signal to take a short position. ATR is rising. Usually ATR rises during the onset of a trend because the range of the market is actually expanded. So at this point in time, if you use ATR as a risk measurement, if you go back to the same principle 1 to 2, you're looking at 24 points as your risk, 48 points as your target reward. So that's how you set your target reward and your risk accordingly. But keep in mind, it's more of the risk measurement that is more important and more critical whenever you look at trading in general. Okay, so this is what happened next couple of bars. I think your target profit here. So again, the same argument can, the market continue to hit down south. We are not into that position because we got stopped. I think we got our profit pretty much early on. So like I said, there's always opportunity because you have predetermined your target and your stop loss accordingly. There's always, once this trade is done, look for the next setup. And market will always be present with opportunities. So always make sure you're disciplined enough to uphold your trading plan accordingly, as well as set up to do in the beginning. Okay, so FQI is the same principle. Importantly, I think very critically is to look at ADX. So as long as ADX is rising above 25, that generally tells you the market trend is this downtrend that we're seeing, especially with the appearance of red Heiken Ashi bar, is slowly showing you strength. And ATR value at that time is 4 points. So generally FQI is actually a smaller volatility product. It experienced lesser volatility as compared to CPO. In terms of percentage-wise, CPO is generally more volatile in nature. So if you are new to futures market, if you want to start off with a product that is less volatile, it's a good to consider to look at FQI as a market to start off with. So these are setting your targets, same principle, looking at risk reward 1 to 2. So if the ATR has 4 points, you are willing to risk 4 points as your risk, 8 points as your reward. So that's how you work on a 1 to 2 risk to reward ratio. So this is what happens in the next few sessions. Again, I think you pretty much hit your target, but the market continues on one direction. So the same principles apply. If you're set up to do, stick to your trading plan accordingly. Now, obviously, there's a couple of tweaks you can do. If the next time you notice that if the market tends to go even further, what you have exited earlier, it shows you that the trend continue way more than what you've or way ahead in the later sessions. Then perhaps maybe you can tweak your way, but maybe you can, instead of looking at risk to reward fixing your ATR, we can use ADX as a measurement. So probably you want to wait until ADX starts to peak or starts to decline. That's usually be one good direction for you to look at, or when there's a crossover. So you can do that, you can tweak it accordingly. But having said that, always you must have a way. Importantly is to always get yourself out in case the market go in the reverse. Okay, now so that's pretty much covered on how to really set up your trading plan structure. Now as been trading this market for quite some time, importantly, I think a lot of people always miss this, is that people tend, especially those who are new to trading, is that they don't like to do reviews. So when you finish a trade, whether it's win or lose, they just forget about it. So especially during a winning situation. So winning trades, you tend not to to understand, to analyze more. Losing trades, sometimes you're too emotional, you also tend not to do it. But very critical, as if you are new to the trading journey, you must have a way to do a self-review, especially when it comes to trade performance. So these are some of the metrics you look at: win-loss ratio, profit and loss. So it's not only about P&L. At the end of the day, you really need to look at other parameters as well, whether it's how's the equity curve, the traded volume. So these are all very numerical metrics. There's also other metrics like how are you feeling, what approach or what analysis you did on the market, how is that come to fruition. So trade review is very critical, especially if you are new to trading journey. In fact, I think it's very important to have all this data. There's no point if you don't understand yourself what went wrong, especially what area that is a weakness, if you don't have all this trade review happening around you. Okay. So the key to successful trading is always about minimizing your loss. If you put a very fixed amount, I mean you put a very small amount of risk, generally you can extend more trades accordingly, because in each trade you risk very minimal. Obviously, if you want to risk more, then your reward could be higher, but your risk of ruin, or the recovery it takes for you to recover that risk, the big risk, is never easy. So like for example, if you're willing to risk 50%, it takes 100% effort to really recover back your account to par. So that's a lot of effort to bring back to recovery if you risk a big amount. So really is to always keep your losses small. In that sense, hoping that in more execution that you do, your probability will be in your favor. If you execute rightly. Okay. Now, other important consideration. So I've talked a lot on technicals. Combining technicals and fundamentals can probably give you a better picture. So normally what I do is that really to put all into interplay. Now, technicals is the one that navigate my day-to-day decision, but I think even look at overview where the market is heading, it's good to have a big grasp of the fundamentals as well. So if you've been trading in CPO market, CPO is a very commodity driven. So supply and demand dynamics, you can't run away. If your market is oversupply, generally that tells you, prices tends to come down. If the market is under supply, the price will have to go up. Now, FQI is a very index-driven market, so it based on sentiments, external market sentiments, and obviously domestic economy sentiment as well. So I just going to cover very briefly some of the factors, the key factors to watch out for if you are trading CPO market. First thing is always to look at supply. So right now, if you look at it, why CPO tend to be well liked, or many people likes to trade CPO market, is because look at the tendencies, the seasonal tendencies are actually quite strong. So right now we are in August, September. Normally production tends to pick up. When it comes to October, November, January, the production starts to come down. So normally you start to see higher prices towards the year end. Why is that the reason? Because you look at seasonal tendencies, we are usually at those periods we are entering into high production period when it comes to the CPO market. And by year end, those production figures will start to come down. So we tend to see there's a bit of pattern when it comes to those prices as well. So stock levels are important. Like I said, supply is strong, stock level is going to be high. That is negative for price. So it always goes back to supply and demand. You can't run away too much from that. Okay, so you look at it, when you have high stock levels, it's bad for prices. Low stock levels is going to be good for prices. So key levels to watch out if you are trading the CPO market is stock levels, not approaching above the 2 million mark. Once you approach above the 2 million mark, that generally tells you the market is a bit oversupplied. Okay, now export trends is not so clear like production. Unlike production, you roughly know by year end you should see there's a decline. Export, on the other hand, it tends to be a bit mixed signals, but generally I think around August, September, normally tend to see a bit of pickup because India is a very big consumer for Malaysia palm. So during that, they usually buy a bit more before the festive season kicks in during the Diwali, which is end of October or early November. So these are some of the seasonal tendencies. Other than that, it's not so strong and not so clear as compared to the production pattern as we see in back in the earlier slides. So a key factor to watch in terms of demand is always China and India. Now, if China starts to demand less and India starts to demand less, you can start to see prices starts to come down. And if China and India starts to purchase more, that usually means prices will tend to go up. So because these two are generally the biggest consumer. If these two are not buying, then we will have a problem. So generally, we have all these inputs in order for us to probably derive an expectation in terms of where prices can likely to head in the foreseeable future. Now, another parameter or factors, if you are trading palm oil, you look at crude oil and CPO, there's a bit of tendencies there. High crude oil price should support CPO because there's always this argument of biofuel, food versus fuel. So when you have high oil prices, normally there's a lot of conversion to biofuel. Low oil price, there's not much incentive. So right now, I think oil price generally is quite low. So that could be a bit of weight in terms of sentiment pressure for CPO market. But these are the relationship now that you should be aware of. You are trading a CPO market. We should, if you want CPO prices to stay strong, you need to have high oil price environment. Okay, now FLI is a different context. Again, those days we like to compare. If Dow Jones is doing well, there's a high tendency that FLI would tend to do well as well. I think gone are those days. You look at where Dow Jones is heading is pretty much all-time high. But unfortunately, Malaysia market or FLI in general is not at all-time high level. So there's a big gap. There's a big discrepancy between Dow Jones and the FLI market. But again, I think in terms of direction, the parallel movement is actually quite there's quite a positive relationship, but I think the strength of it in recent times has actually been weaker. Really, I think US market is on its own trajectory, and Malaysia market seems to try to play the catch up, and is facing a bit of a headwind in that sense. Now, if you look at trading FLI, one factor to look at is looking at ringgit. As long as a weaker ringgit, that usually means weaker index performance, because when you have stronger ringgit, that means there's more demand for ringgit. That means foreign inflows are coming in. So generally, that also means stronger index. So right now ringgit is actually doing quite well. So in a sense that FLI performance seems to be doing fairly good as well. So that's usually the relationship in that sense. So now, if you're trading FLI, I'll rather say this, the foreign shareholding is a very big element. So really, if you really want to see how the FLI can perform, you really need to see the foreign shareholding. If the foreign shareholders are not coming in, generally you can't see much of index performing well. So you want index to perform well, you need the foreign shareholders to come in. So that's one a major way to look at how the FLI will perform, by looking at the foreign shareholders. If the foreign shareholdings are not coming in, generally, FLI can't really do or can't really perform well. Now, just to show you a bit of seasonality. Now, FLI, you look at it, over past 5 years, generally August is a strong month. So let's see, we are just only 2 weeks away or a week plus away from the end of August. Whether could we close the month positive? Looks like we can. So it looks like August is a strong month for FLI, but once it comes to September, October period, we should be a bit more wary. Now, these are all historical and seasonal. So it's not saying that this year we should be following the last couple of years. It may not be the case. This year could be different, but you can use it as a guide. If you are entering into, especially August is a strong period, you should be careful trying to short the market. Especially when you have a strong bullish phase, you should try to find position for it to long rather than short, especially when you have seasonal tendencies, like it's a strong period at that particular time. So just to give you a technical view, I think FLI in January is still on a short-term uptrend, but just look at ADX. ADX, it starts to peak. Right now, it's still above 25. It's telling you there's still trend in place. This uptrend is still quite strong. But if ADX is reaching its flat level and is pretty much not moving as high, then we will have a problem. So that generally tells you that 16,006 seems to be a very strong resistance, psychological barrier. If it doesn't cross that, that also tells you generally the market may poised to go lower in time to come. So watch out. ADX is still pointing to you that it's still rising, but it's not rising as fast. It may peak soon. If it does peak, then really I think this short-term uptrend is likely to face exhaustion in time to come. Now, SCPO is interesting. Now, with SCPO today's movement, you can see that definitely I think ADX is still hitting well. But I think really the key level to watch is the 4650, which I think is quite difficult to reach. Because I think the strength lately, I think as of today, if Jomo continues to be a red candle bar, very likely I think this uptrend is probably going to be exhausted. So really to watch, but you look at where it moves from 4100, it's still way above both the moving averages. So technically, the market on the longer or medium term phase is still an uptrend market. And plus with fundamentals, as we head into the third and fourth quarter, normally is where the strength, the fundamental strength will come in, which means that price will tend to do well, especially hit to the third and fourth quarter. So I think crucial to watch. whether can we break this key level 4650 in the immediate term. If it doesn't, then I think there probably could be a short-term retracement. Then eventually, I think the market can poise to go even higher. Again, watch out on the ADX. If ADX continue to rise, that means this uptrend, there's still strength in it. If it doesn't, then I think you have to be very careful of this uptrend that is happening in the CPO market. Okay. So just to recap, I think what I mentioned is by creating a trading plan is important. You must have a plan to get yourself in and to get yourself out. Importantly is to manage to get yourself out, manage your risk. Always set clear rules. If there's no justification for you to take a particular trade, you can't explain in proper way. Normally, it's not a good trade to take. I think it's important to keep a trading journal. Other than that, I think whatever I mentioned today is purely is talking more of technicals and the methodology of trading. But I haven't really involved the other important aspect of trading, which is the mental part. Now, mental capital, mental capacity is an important aspect when it comes to trading. Trading market. So without this mental aspect, technically it's very difficult for a trader to progress. So eventually, if you're doing this full time, trading is very resource consuming. It can weigh you down emotionally, physically. So you must have a right balance in order for you to keep, if you want to continue long on this trading journey. So just to conclude, I think really, it's always good to trade with the trend. Like I mentioned earlier, if the trend is bullish, find position to long rather than short. If the market is downtrend, find position to short rather than long. Heiken Ashi is one good tool for you to look at if you're looking at trends. You pair that with moving averages, you pretty much can get a good signal to in order for you to time your entry and exit accordingly. Now, DMI, the crossovers are in a way overlapping moving average crossover. So DMI, I think the main use is to look at ADX. So ADX gives you basically an indication to gauge the strength of the trend. Whether the trend is still strong or there's not much momentum left with the market. So really, I think that's the main benefit of looking at DMI is mainly for the ADX. Now, last but not least, manage your risk by looking at ATR value. Use that ATR value as a way to set your target profit and your stop loss accordingly. So I'm just going to end here with just two quotes. So, it's always said that, Paul Tulujan is a great trader. So he always mentioned this, don't focus on making money. It's always focused on protecting what you have. So it's always about risk. Once you manage your risk well, eventually the reward will come. So Tom Hogarth, if you have not read his book, he wrote one very good book called Best Loser Wins. I think if you want to know more about trading, more about managing risk, read this book called Best Loser Wins. So I think he mentioned this belief in defining his risk. It's never about the reward, because once you define your risk, like I said, the reward eventually will come. So I'm just going to end here. I'm just going to open the floor for any questions. So over to you, CY.